I am Vetrivel, Assistant Professor, Department of Commerce with Banking and Finance, Erode Arts and Science College, Autonomous Wing, Erode. My subject is Financial Management. Introduction of Financial Management. Financial management is the blood and nerve center of a business. Just a circulation of blood is essential in the human body for maintaining life, and finance is very essential for smooth running of the business. Meaning of financial management. Financial management refers to the management of flow of funds in the firm. It deals with the financial decision making of the firm. It is mainly concerned with the timely procurement of adequate finance from various sources and its utmost effective utilization for the attainment of organizational objectives. Definition of financial management. According to Solomon, refers to that financial management of concern with the efficient use of an important economic resources, namely capital funds. Then, according to J.F. Bradley, says to that financial management is the area of business management devoted to a judicious use of capital and a careful selection of sources of capital in order to enable in a business firm to move in the direction of reaching its goals. So that is the definition of financial management. Scope of financial management. Financial management has undergone significant changes over the years in its scope and coverage. In order to have a better exposition of these changes, it will be appropriate to study both the traditional approach and the modern approach to the finance function. Differences between traditional approach and modern approach. Traditional view and modern view. This traditional view's conflict is very avoidable, then modern view conflict is inevitable. Here, traditional view conflict is disturb the organization and prevents optimal performance. Here, modern view conflict detracts from organization performance in varying degrees. Then traditional view optimal organization performance require the removal of conflict. Here, optimal organizational performance require a moderate level of conflict. Here, traditional view conflict is caused by management error in designing organization or by troublemakers. Here, modern view conflict arises from many causes including organization structure, unavoidable differences in goals, in perceptions, values of specialized personnel, so on. So this is the differences between traditional approach and modern approach for scope for financial management. Objectives of financial management. Efficient financial management requires the existence of some objectives or goals because judgment as to whether or not a financial decision is efficient must be made in the light of some objectives. The objectives of financial management are broadly divided into two types. First one, basic objectives, then other objectives. Basic objective. The basic objectives of financial management are profit maximization and wealth maximization. First one is profit maximization. Profit maximization is one of the basic objectives of financial management. According to this concept, a firm should undertake all those activities which add to its profits and eliminate all others which reduce its profit. The subject highlights the fact that all decision financing, dividend and investment should result in profit maximization. So these are points. Profit is yardstick of efficiency on the basis of which economic efficiency of a business can be evaluated. Then the rate of return on capital employed is considered as the best measurement of the profit. Profit acts as motivator which helps the business organization to be more efficient through the hard work. Then last one, by maximizing profit, social and economic welfare is also maximized. Wealth maximization. Another basic objective of financial management is maximization of shareholders' wealth. This objective is also known as value maximization or present worth maximization. According to this concept, finance manager should take such decisions which increase net present value of the firm and should not undertake any activity which decreases net present value. This concept eliminates all the three criticisms of the profit maximization concept. Functions of financial management. The functions of financial management is estimate to recruit capital, determine capital structure, evaluate and select sources of funds, allocate and control funds, distribute profit or surplus, monitoring financial activities. So these are all the functions of financial management. Sources of financial management. Basically, the three types of main sources of financial management: basis of time, basis of ownership and control, basis of sources of generation. The first one is basis of time. That refers to three types of basis of times and sources of finance: long term, medium term, and short term. Long term is include as equity share, preference share, internal accruals, debenture, bonds, term loans, venture funding, and asset securitization. Then medium term includes the preference share, debenture or bonds, medium term loans from financial institute, government, commercial banks, and lease finance and hire purchase finance. And last one, short term finance, is refers to trade credit, short term loans like loans, fixed deposit for a period of 1 year, advances received from customers, creditors payable, factor services, and bills discounting. So these are all the basis of time. Then second one, basis of ownership and control, own and borrowed. This is the basis of ownership controlled sources of finance. Own method in include equity capital, preference capital, retained earnings, convertible debentures, venture fund or private equity. Then borrowed, loans from financial institutions and commercial loans. And last one, debenture. Then last one, sources of financing. Basis of sources of generation, internal and external. Internal is equity capital, preference capital, retained earnings, convertible debentures, venture fund for private equity. Then external, retained profit, reduction of working capital, sale of asset, etc. So these are all the sources of finance.